This is a 25 marker question from Edexcel paper 3. It's covering interest rates and their effect in developing economies, specifically Kenya. So we're going to talk about things like economic growth. We're going to talk about business costs and business investment. We're going to talk probably about long and aggregate supply, factors of production, some other themes within developmental economics. As always, I suggest that you watch maybe the first bit of the video, pause it, go back and try and come up with your own answer, and then watch the rest of the video to see what I write. That way you can sort of get maybe an assessment of whether you're on track with what you're writing, or just how what you're writing compares to what I'm writing, because there will be a bunch of different things you can do to answer these questions, especially with paper 3 when you're doing both microeconomic and macroeconomic. So what I've done, there's a bunch of extracts for this topic, but what I've done is I've taken the information from extract G, which is on interest rates in sub-Saharan Africa, so that's kind of specific to this question, and I've pulled out some key pieces of information. So we have Robert Matsiko, who's a local businessman, faces a 22% interest rate on loans when he tries to buy machinery. That is quite a high interest rate to pay on a bank loan for a business. Kenya's central bank rate has fallen from 20% to 7% in the last decade, so decreasing sort of central bank rates, quite significant decrease, and a big gap between the amount that banks are lending and the central bank rates, right? So they're charging a pretty big premium. They're lending at about 6.8% above the central bank interest rate. So that kind of suggests maybe they're nervous about risky business ventures in the Kenyan economy. And then also we have this piece of information about there being high birth rates, and this meaning that lots of families are not in a position to save money. That's generally going to mean that there is lower rates of investment overall in the economy, because the saving rate in an economy is a really big part of the amount of investment that you have available. So for this topic, I'm going to break it down into two areas. And with paper 3 questions, I tend to go one area being microeconomic and one being macroeconomic, just so that you're sure that you're hitting and covering your bases. So my main microeconomic effect for this is going to be an increased cost of borrowing for businesses. That increasing fixed costs, decreasing costs of borrowing for businesses. Because you're lowering the interest rates, and that will sort of decrease fixed costs for those businesses. And then second, that we're going to have an increase in aggregate demand as government spending and consumption increase in the economy. For our first topic, in terms of definitions, I'm probably going to define terms like define interest rates, define fixed costs, maybe define things like economies of scale, or price elasticity of demand, if those come up in the analysis that you're providing. For the application, I'm probably going to go with this first piece about the 22% cost of a business loan for Robert Matsiko. I also might include the piece about Kenya's bank rate falling from 20% to 7% in the last decade, because I think that sort of, you want to almost lead with that somewhere in your essay, because maybe you put that in the very introduction. But just to sort of highlight that that's maybe the main trend that we're looking at. In terms of the analysis, I think I want an explanation that's connecting that lower bank rate with lower interest rates in general in the economy. So, because that's the rate at which commercial banks are borrowing from the central bank, that's going to affect the interest rates that they're setting for consumers and for businesses. The question is saying that interest rates as a whole are going down. I mean, it says effects of decreasing interest rates in Kenya. It's not specific to the bank rate. So I think we can also assume just generally that interest rates are falling, but I would want to see that link, that explanation. And then I'm going to explain how that's going to lead to lower fixed costs for businesses, because the cost of servicing their debt is going to go down. And that means ultimately they're going to be able to make more profit. As a business, they're probably going to be able to invest more and expand more as businesses. I'd also expect that it means businesses don't have to have as high an output in order to be able to achieve profitability or hit their break-even point. Because if the fixed costs are smaller, that means you don't have to sell as many units to be able to cover those fixed costs. I might also want to talk about here how businesses are more likely to get bank loans, and it's going to be a lot easier to achieve economies of scale because they're more willing to borrow the money if it's sort of more affordable. And then that means that they're able to invest and maybe get their business to a point where they're able to reduce variable costs as well because they're able to negotiate maybe better prices from suppliers. So overall, I think generally the picture is this is going to be beneficial for businesses. It's going to allow them to grow. What I would say in terms of valuation is you want to offer a picture of maybe why the future is not as rosy for businesses in Kenya. So there's two big things I'm going to pay attention to here. One is probably that there are other limiting factors for businesses, especially in a developing economy. You'd expect maybe there's poor infrastructure, maybe the workforce has lower levels of education. It might be the case that labor costs are fairly high. That's generally true in Africa compared to Asia, for example. And so those factors might mean that just having access to lower interest rates doesn't mean that businesses are able to expand in the way that we maybe would like them to. I might also point out that there's this piece of information and context they're providing where banks are lending at meaningfully 6.8% above the central bank interest rate. So you could make the argument that maybe lowering central bank rates are not actually going to translate to lower borrowing costs for businesses. There'll be a bunch of other stuff you can say here as well, but that's kind of what I came up with. For topic B, macroeconomic effects, I'm going to look at aggregate demand. And whenever I do aggregate demand in any kind of macro essay, I'm always defining the four key components: the consumption, investment, government spending, and net exports. I might also talk about things like long-run aggregate supply or marginal propensity to consume. Just define terms based on whatever your argument is going to be. I'm going to have this diagram where we see a rightward shift in AD from a negative output gap, right? So just kind of the standard classical model ASAD LRAS diagram. In terms of sort of application, I might be interested in maybe, this will make more sense once I've explained the argument, but the population growth data that they're providing in the first extract might be useful to show a big increase over time in population in Kenya. That I would expect to translate to a higher long-run aggregate supply because you're increasing the size of the workforce. Now, we're also kind of assuming there that they're getting adequate education to be useful for businesses, but provided that's happening, we would expect population growth to be good for increasing long-run aggregate supply. The analysis here is going to be the two components of aggregate demand increase. That the government spending increases because we have lower interest rates and therefore borrowing for governments also becomes more affordable. So they're more likely to borrow more money and spend more money in the economy, thus boosting aggregate demand. And also that you're going to have lower borrowing costs for consumers, so on sort of credit cards or mortgages, and that means more consumer spending in the economy. Therefore, we get higher aggregate demand and higher economic growth. The reason I'm not talking about investment is because that piece of information I told you about in the beginning, where we said we had a super low saving rate in the economy, I'm kind of assuming that that means that better interest, that the lower interest rates are not necessarily going to affect the investment rate as much as otherwise might be the case. But definitely one of the arguments you could make is if interest rates are lower, that might disincentivize saving. But that also would then mean that there's less investment in the economy because people's savings, like your pensions and long-term savings, make up a big chunk of most countries' investment pool. So that's something you could talk about. I don't necessarily think that's super relevant here because savings are not a massive factor already. So lowering the incentive to save, I don't think is going to change that much. But that could be something you talk about in evaluation. What I'm going for in evaluation is this idea that long-run aggregate supply is probably going to be a limiting factor in a developing economy. Because you're not necessarily going to have that many sort of factors of production that are in a really strong position aside from natural resources. Like your population might not be that well educated, your infrastructure might not be that good. And that means that trying to just boost economic growth through increasing aggregate demand isn't necessarily going to translate to meaningful, sustainable, long-term economic growth. And I can demonstrate that on the diagram, right? So if we're pushing beyond long-run aggregate supply, we're then at significant risk of demand pull inflation, which would be another evaluation point that you could make, is that all of these increases in aggregate demand could have the effect of triggering inflation in the economy. In terms of judgment, then I'm going to try and bring all these ideas together and say basically, Kenya should experience a pretty high level of growth because at the same time they have an increased ability of businesses to meet demand and increasing demand in the economy. So if you have lower interest rates, businesses are able to expand more easily and meet demand. And then, of course, you also have the increases in demand that we just talked about. But I'd offset this by saying, there might be limiting factors like infrastructure for both business growth and how much economic growth you can realistically get from increases in AD, because long-run aggregate supply remains a sort of pretty big limiting factor in a developing economy.